Good afternoon, everybody. Welcome to Selecting an Option Strategy. I'm Connie Hill, where we discuss what's going on in the market and try to determine maybe what option strategy might work well given the conditions that we're looking at. Now, have you guys noticed what's been happening with implied volatility as well as the average true range of the indices? Have you seen what's been going on there? I think we're going to go take a look at that, and that might lead us give us an idea of what strategies we think might work out best in this environment. All right. I'm happy I am joined here by Cameron May in the chat. Cameron will help me out answering any questions maybe that I can't get to. All right. He'll help me fill that, but feel free to ask questions because this is a great place for you to be able to get your questions answered. Now, I hope you're following us on X. It's it's easy to do. I'm at Connie Hill CS. Cameron is at Cameron May CS, and we post educational content throughout the day. Things we notice that we think you might find interesting is something that we do like to share with you. So let's go through our disclosures and get down to business. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for educational and informational purposes. It shouldn't be considered a recommendation of any sort. We'll be using the Paper Money software application. It's for educational purposes only. I think it's a fantastic tool to get to know Thinkorswim and the type of investing and trading that you like to use that Paper Money site. Spread trading must be done in a margin account. Past performance of any security or strategy does not guarantee future results or success. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. An in-the-money option has a higher risk of being assigned. One thing you need to know is Paper Money does not assign early, and so that's one difference that Paper Money has from your live account. Your live account absolutely can assign early. All right, want to give a little plug for some upcoming workshops that we're having in the 3D cities, Detroit, Dallas, and Denver, coming up over the next 5 or 6 weeks here. If you live close to any of these, can get there fairly easily. It's worth your while to do so. We treat you great. We feed you not only food, but we feed you great educational information. Some people just really love that. Heard some really good feedback from those that went just last week or last weekend down in Scottsdale, Arizona. They loved it. Okay, so I'm just going to encourage you to be able to, if it's something that you can do, take advantage of it. All right. In our class here today, we always want to see what's going on in the market, and it's been just a lot of wild days, hasn't it? Yeah, it certainly has. We like to just kind of take a look, see what's going on, and then determine maybe what option strategies we might lean towards. And of course, we're going to look at a lot of different examples. While we go out and take a look at the markets, I want you, if you are trading a strategy that you're feeling like, hey, I think it's really working in these market conditions, feel free to share it in the chat. Okay. It doesn't mean that you guys are all going to come back with the same answers, because I bet you really won't. Okay. But go ahead and chat that in. Let's go take a look at the S&P 500, the SPX. And, oh, interesting. Okay. I was looking to see, it looked like maybe towards the end of the day, we were having some more selling off activity. Let's go ahead and just kind of zoom in here. Earlier, it looked like we even had a hammer candle here. And when I say earlier, I'm going to say maybe about an hour before the market closed here. Looked like this was more of a hammer candle. The body was a little bit smaller, and the shadow was a little bit longer. It was looking hammerish, I should say. It was more like a doji, but it was hammerish looking, which could mean potential reversal for the next day, but we're not ending up with a hammer today. Yeah, we're not. What's happening here with implied volatility and the ATR? I'm going to back up a little bit here. I want us to have, like, say, a full year view on this. And what we've noticed just more recently is notice the ramping up of implied volatility. It's not quite to this peak point that it was back here in August. Okay, we had that little August event where the market dropped and VIX skyrocketed, right? So it's not up quite that high yet, but it is just incrementing higher and higher and higher. That gives us an idea, okay, implied volatility. We're going to expect bigger moves in the market. We're going to expect option prices to be more expensive because that's definitely a calculation part in the premium. And then on our average true range, one thing I was noticing here is the big ramp up. The days, the big swings between the high point and the low point are getting bigger and bigger here over the last few days. I mean, right here, it was down here about 58. So a 58-point swing from the high to the low in the SPX. Clear up here to today, it looks like it's going to end around 100. A little bit of change there. So 100-point swing in the index on a given day. That's a lot. Okay, so if you are feeling a little skittish in the markets, you're feeling like, man, this is kind of tricky for me to trade. Don't feel like you have to trade. You don't, right? You only want to be trading when you're feeling comfortable, right? When you're feeling comfortable with your environment, what you're looking at. But if you're not, nobody's saying, hey, buddy, you got to do that. Okay, that's just not the case. Now let's look at the NDX. NDX is looking really similar here today. Big wide swing. We see those shadows on either side of the candle here. That lets us know there's volatility. Same thing here. Implied volatility ramping up, ATR ramping up. So we are getting bigger swings in the market. Somebody says, yeah, I'm getting a little whiplashed here. Yeah, you might feel like that. Absolutely. Now, I do want to take a quick look at the chat and see what kind of strategies you guys, if you felt like something was working for you, to let us know what it was. So Greg says, I've been doing long puts, doing short synthetics, and buying stock. Scott's saying, now I'm getting whiplashed. And Greg says, I'm with you, Connie. I'm patient. Yeah, there may be some of you that feel like, I'm just going to be the observer right now. I don't feel like I have to jump in. Now, let's go look at the different strategies that we might consider, okay, as we come back here. So we've got our bullish strategies. Now, one of you is actually buying stock. Greg said he's buying stock, so that obviously would be a bullish strategy. But if the market keeps selling off, more likely than not, I don't think you're going to be feeling like doing a lot of bullish strategies. Okay, so let's come. We're going to kind of mark this column off. All right. I think people might be a little inclined maybe towards those bearish strategies, knowing what the market's been doing. But let's talk about neutral strategies for a minute. There can be some neutral strategies that some people might consider where they're selling premium. Okay, so maybe an iron condor where you have a short put vertical and a short call vertical. If you're comfortable putting on the short call vertical side of that iron condor, could be a strategy. But most of these are looking for just a little bit of movement or precise movement. So say like a calendar spread, many times when we're looking at that, we're looking at fairly neutral and then maybe slightly bullish or slightly bearish, okay? When we have a really big ATR out on those indexes, that might lead us to say, maybe calendar spread or diagonal might not be the best if we're expecting things to stay in a range, and instead we're getting things that are really dropping out of ranges, okay? Now, a butterfly spread, typically when we put on a butterfly, it's generally a lower probability trade, but it pays off really nicely if you can nail with your short strike prices in the middle where you think the butterfly's going, where you think that index or stock, whatever it is you're trading, is going. But again, it is lower probability, and there are not lots of possibilities to be right with that one, if that makes sense. All right. Now, double diagonal. We haven't done one of these for a while. We did a little bit earlier in the year, I think maybe in January, we broached this topic with the double diagonal, where we are kind of similarly, looking for a range of movement. But if you feel like the range keeps expanding and expanding, that might be a little bit trickier to try to set up a trade that way. Okay. Greg says you were forced to buy stock. Oh, maybe had a put that was short and you had the stock put to you. That very well could be the case. John says, I'm putting that X over to the bullish strategies. Yeah, it's like, do we need to think about them? Maybe not right now. Could there be some bullish stocks? There could be. In fact, this morning in my X, I put down, there were a handful of stocks that were actually coming up in my early morning movers bullish scan. Not a ton of them, but there are a few. And so they may be stocks maybe that you're following really closely. Maybe you're holding on to positions and hedging with them, and maybe you want to sell calls on them, or maybe put on a collar type strategy for some protection. So that very well could be the case. But as I'm looking at things, if we're getting some real big moves, maybe some of you might consider a long put, right? What are we going to have to know about that? It's going to be expensive, right? Implied volatility is high. It's higher in a lot of stocks. So that just means, one, there's an expectation of movement. Two, you've got to know that it's going to be pricier. And so maybe you can work some things around that. Again, maybe short calls against some of the stocks that maybe you're holding on to, if that is the case. Short call vertical. Definitely a selling strategy. When implied volatility is high, like what we keep seeing, many times we just will stick to some selling type strategies, right? When volatility is low, maybe we edge to the buying strategies. And if volatility is a little bit higher, edge towards selling strategies. Now, let's go take a look at a couple things. Number one, I want to do a quick review, and I mean a really pretty quick review of a couple of our trades and how they are doing right now and how one of them finished. And then I have several examples I would like to get into here today. Okay. Joe Blow says, short stock, definitely bearish. One of the scenarios with a short stock strategy is that it puts you in a situation of having quite a bit of risk on the table, right? If you're short the stock and you're expecting it to drop and it goes the other way, maybe something happens in an announcement from the White House. It seems like it's happening all the time, right? And many times that is causing the market to just kind of have a knee-jerk reaction really quickly. So it could put you in a difficult situation if you're not working with a fixed, defined, I'm going to say, risk strategy. But obviously it is something you could consider, right? Definitely a bearish strategy. Now let's head over here back to Think or Swim here for a moment. I want to come over to the Monitor tab. And in our class, we have one trade that is going on right now. We put it on last week. And let's go look at the chart here. We had an initial target here to get out at 115. Okay, think we're going to be there? Probably not. Okay. So we did a vertical here with the expectation, we got in here where the green oval is. We, let's see, that was the 5th. We actually talked about it the day before, but we got in here at the 5th. At the opening of the market, we put on a conditional order and said, you got to go above, I think, whatever that day's high was in order to place the trade, and it did. So that worked in that scenario. Run up a little bit, pull back, but, our target was up here. We're looking at initially around 130. Now, it's not anywhere close to that, is it? It was rallying a little bit today. I went in earlier and I changed our exit orders on it. We have earnings on Wednesday before the market opens. And so when we got in this trade, we said, okay, we're not going to hold over earnings. We're going to try to be out before earnings. But really, we're going to make sure we're out before earnings tomorrow. Okay, so I put in maybe some shorter areas, right, to hit for targets. High today was at 111.69, And knowing that the ATR is pretty decent up here, around $8 or so a day, maybe it would be feasible to get us up to about 115. Now, we didn't get there, but that's what I changed our target to. The other target I put was just below today's low. Because if this thing swings down on us, we don't have time to recover if we want to be out by options expiration. I mean, by earnings announcement. Said the wrong thing. Earnings announcement is our biggest concern here. So in our working orders, this is what we have. So we have the target to go to 115. Now, tomorrow, things are just kind of maybe not moving so much. We just might have to just close those orders and just get out. Okay. We're going to have to keep a close eye on it. And then 106.90, if it goes below 106.90, that's just below our low today. So we would want to get out as well. But we could just say, let's just take whatever profit we have at this point and go be on our merry way. We could do that, okay? And we may end up doing that tomorrow. But for right now, we'll see if in the morning we get a little bit of a movement. Who knows if we get another knee-jerk reaction, market goes up or the stock goes up better. That could be the case. Let's see here. Greg said, I like to see an example of a short equity position for an option for protection. There are several classes that could entertain that particular strategy. In our class, and actually all our classes we're limited to stay kind of within a lane, okay? In my class, we really don't do anything with stock, okay? We're only doing option strategies, and for that reason, I wouldn't show you an example like that, nor do I have it in my agenda for today. But there are lots of classes that may show exactly that type. Cameron mentioned one of those. What did you say here, Cameron? Ben's protective puts with stops. He put a particular video out there that might be helpful for that specific purpose. I'm also thinking of James' class about the Master Series, where he entertains pretty much everything. Okay, he'll entertain everything in that class, so a little bit more of an opportunity. Now, it looks like, and in the chat, it looks like they have just put in a what we call a survey for you. And from time to time, we do this, kind of get your pulse on this particular class, what's going on here today. It's kind of early in the day, so I wouldn't really expect you to do the survey yet, but if you'll click on that link and just have it active, then when it's time for you to go or the class wraps up, then you can go ahead and just fill out that survey. If you haven't seen it before, it's an easy survey, and I'm a fan of easy surveys. 2 questions. Fill in the radio button on a scale of 1 to 10, okay? 1, I hate it. 10, I like it. I would love to come back, okay? And just mark down what you feel there. There are 2 places where you can answer a question. You can choose to do that, or if you want to communicate something to me of something you would love to see covered in this class, I love to bring those into our discussions based on the things that you guys are saying. Hey, could you talk about this? Or maybe I'm struggling with this concept or this process. Let me know so that I can weave that in. Okay, so that is one of the great things about the survey. So we always appreciate it when you take the time to do it. Cameron will post that again throughout our session. And I'll try to remember to remind you at the end as well, because that is very, very helpful to us. We appreciate that. Okay, let's go. So that's our FU2. And it looks like this kind of needs to be moved up into this area, but I'm not going to take the time to do it. Now, we had another trade that we put on last week that I want to just review with you real quickly. And it was the RNA. We are doing another bullish there as well. This was I believe this was a short put vertical, but you could see it been trending really nice. It wasn't even noticing that we were having a pullback in the market. Okay. We looked at it here. It was bouncing off this bottom channel line, which is lovely to see, right? Nice little bounce there. It got us in the next day. We were down one day and we were closing outside of this channel, and the whole market was selling off. And sometimes when you see that going on, even though maybe your stock hasn't been majorly affected by it before, it can start filling it. Okay. So what we decided to do was to close the trade. Sometimes you get in a situation where, and we've done this on several trades, where in this case we could have bought back the short put and hope the long put would just drop and make up the difference there. But what I decided to do, seeing that it was really impacting that trade, was just to take a small loss on it. It's like, okay, it broke down below some support that has been steady Eddie for over 3 months. And so we did. In the end, on that particular trade, and the day we got out, you can see I just kind of put it in pink here. We ended up, we brought in, let's see here. Let's go to the numbers real quick on the account statement. So here was our initial trade over here. Okay. In this case, I was saying it was a put. It was actually a long call vertical. So actually a little bit even more bullish. Okay. We bought it for 246 with the expectation that the stock would go up, and that we had in a $5 wide spread about 254 to gain. Okay. So kind of almost like risking $1 to make $1. But we went and bought it back for $1.42. That left us with a loss on that of about $1.04 for our 3 contracts. So we lost about $312 on that trade. Okay. Could it have still worked out? It could have, but sometimes when you just see the whole market selling off, it might be, let's kind of protect what we have there. And if it recovers and the market recovers, we can always get back in. Okay. All right. So those 2 trades, Futu and Verona. Okay. Let's take a look at some stocks that look to be more inclined to be useful for bearish trades. Okay. First one we're at here is ALB. Now, ALB, volatility has been going up, just like what we were seeing in the markets. Its ATR was starting to go up. It's kind of holding steady now. But what we can see is, what has it been doing? Dropping, making a little run up, dropping again. And so we're seeing it drop again, kind of a bounce off this resistance. We would also see here, it's a close below the low of the high day. And this little run up, yesterday was our high day. And so today the stock closed below that. And some people like to use that for a bearish entry. Now, as we come over here, this one is actually traded pretty decent, has some decent volume, over 2.5 million shares traded today. And I wanted to point out another thing about implied volatility. And sometimes this can give you some guidance as to maybe strategies that you might consider. So here, I am looking at current IV percentile. It's an 80. I crossed through it just ever so slightly. Okay. But that calculation just gives us an idea. It calculates the percentage of the last 52 weeks if the implied volatility is lower than where it has been. So in this case, with an 80% number here, that means that only 20% of the days has the implied volatility been lower than where it is. So right now it's kind of in a higher range for that stock. So that can filter into some of our decisions sometimes. So I wanted to bring your attention to that little statistic. Now, it's got weeklies. However, the weeklies were not, some of them were sort of liquid, some of them maybe not so much. So we're actually going to do 2 trades on this particular one. We're going to do the same trade, but in different time frames. Now, generally, we'll sell about 20 to 40 days worth of time, maybe 50 days if we need to, on, say, if we're doing a short put or a short call vertical in this case, because we'd want to be bearish on it. But if things are moving so rapidly, we might consider doing something even shorter that brings in a decent enough return if there's enough open interest there. Okay, so we are going to do this. We're actually going to, we're going to go to these March 21s, and you can see there's quite a bit of open interest here. It's outside of that window, right? It's definitely half at the 20. So this would be considered very aggressive. Okay, so would not necessarily, be for everybody. But what I was looking here, we'll see if these strike prices still look decent or not. Looking at doing 78.79. Okay, let's see. Because implied volatility, we've already set us higher. We can see it's the implied volatility priced into these options that expire in 10 days, about 75%. So yeah, that's higher volatility. So let's go ahead and we're just going to do a sell vertical. Looking here initially on this one, let's get rid of that. We'll talk about that one later. A dollar wide spread, not bad, for 25 cents. Okay, so we'd be risking 75 cents to make 25 cents. So what's the probability of expiring here? The probability of this option expiring out of the money is about 75+%. So that's pretty decent, right? Usually we'll say 60 and higher is where we say that begins higher probability. So we're going to go ahead and do this. We're going to do a longer range one as well. I recognize not everybody's going to be comfortable with this. Okay, I do know that. And you don't have to either. You don't have to be comfortable, but we're going to do a comparison here. And we're going to see if it really does move enough for us. Now, there's one caveat here. What if it doesn't open lower tomorrow? What if it gaps up? Or, even moves in an upward direction? Would we be wanting to get into it? We might not be. Okay, so we're going to say that it has to go lower than where it closed today. So it's closing at 72.67, it looks like. So we're going to make this conditional. So we've got our spread here. And the credit might be a little bit different tomorrow. We're not positive, okay? It could be a little bit different, but we're going to go ahead and maybe even say we could get filled a little bit lower for the possibility that maybe it's going to waver a little bit. So we'll give it, say, like 23 cents. And then we're going to say, release this order if the price of the stock gets lower than where it closed. Okay, so let's drag this up so you can see the whole thing. So we want the stock. We're just going to go with the mark price is higher or lower than 72.67. All right, let's make sure our verbiage is right here. Let's kind of scroll down here. So if it's less than 72.67 or less, then go ahead and fill us on the order. We would be paying attention to it as well to make sure that we got filled on it tomorrow. Let's make sure that that stayed there. It did not, so let's go put that in again. Again, 72.67. All right, we're going to go with that value and hit save. This time it should go. If we're risking, say, about $75 a contract on this, maybe 77, depends on when it goes to, we should be okay doing 12 contracts in this account. So we're going to do 12 contracts. If somebody wanted to spread this wider, you could. Okay, so if you're like, I'd rather buy or do less contracts and have a little bit wider spread, your commissions would be lower, but your credit would probably change a little bit, and then your risk increases more because of that additional $1 step down. We're going to hit confirm and send, and I'm going to put this in our option strategies grouping. Now, the other trade we're going to do with this, we're going to basically do the Aprils. Okay, these are the monthlies. A lot of liquidity out here, so we didn't do that. But what we're going to look at here, we're going to do, let's see if the 80-85 still look decent. So we've got a 34 delta that people generally like to sell a 20-something, 30-something, sometimes into the 40-something deltas. So this is kind of right smack in the middle. Decent open interest. And we're going to sell the vertical. It's going to bring in about $1.17. We're going to go just a little bit lower. We're going to put that same condition on it. Okay. We need it to make sure that it's going lower than where it closed. So we'll put this in, method mark, and we're going to do the same value, 72.67. I think that's the right value. Yeah, 72.67. Get that in, hit save. And if it goes higher, at least initially, won't get us filled initially. It's got to go below today's closing price in order for us to get in. Here we could do, we're risking basically what, $3.85 to make $1.15. So $3.85, we should only maybe here do 2 contracts. Okay, 3 puts it just a little too high for our, well, we'll do either 1,000 or 1,500 threshold. If we were going 1,500, we could do 3 contracts here. Okay. Now, one thing I like to do, I didn't do this on the other one, but I do like to put in an exit order so we know, hey, if it goes the way we expect it to, great, let's get out. And we can do that with a percentage of the profit. Meaning, if we get a big chunk of, say, 115 here, let's go ahead and get out of the trade early. So we'll make it a first trigger sequential, create this opposite order. And, you know, a chunk to you may be different than a chunk to me. All right. A chunk to me is in the neighborhood of 70, 75, 80%. Or, you know, some people will even go 50% if it's in the first week. And if we get kind of some of the big moves we're expecting, it could possibly do that fairly quickly. So let's do this. Let's go $1.15, and we're going to go times. Let's get it. If we can get 60%, let's take the money and run. Okay. So we're going to say if 60% is gone, only 40% is left. So we're going to multiply that by 0.4. We're going to say, fine, go buy it back. If it gets down to around 46 cents, let's get rid of our obligation. Let's go ahead and buy it back and leave us with essentially 60% of what our intended gain is here at $1.15. And of course, we're going to make that good till canceled. Okay. Our expectation is we'll get filled on this tomorrow. If we don't, I'll have to go ahead and adjust it and see if we still want to get filled. All right. Any questions on either of those trades? Greg said, I don't have the 21st of March in your paper account. Oh, that's interesting. Sometimes paper accounts are a little bit different, but I would not expect it to not show you the monthlies. Let me go ahead and send this in and just check on yours, Greg. Just make sure on your filters that you haven't checked something in here that would keep it from showing up. Okay. Like here where it says all expiration types, you know, if you wanted just the quarterlies or just the weeklies, you could mark it. We're doing just, you know, the regular ones here. We're not restricting it. So just kind of check in there. If your March 21s aren't showing, I would be concerned maybe your April 17s aren't showing. And it could be in the settings there. Okay. Looks like Cameron's trying to help you out with that as well. All right. Now, the next ones we're going to be a little bit quicker on. Okay. Disney, man, poor old Disney's really struggling. What did happen today? I didn't check the news, but man, it broke through what had been some decent support in the past around that $100 level. Gapped, clear down. And so we were seeing the trading range, that ATR, the range is getting bigger and bigger. And we're seeing implied volatility creeping up. Okay, so we know, yeah, options are fairly pricey. One thing I meant to do in the beginning, and I forgot to, so let's just do it real quick, was just looking at the VIX and seeing where the VIX levels are. You know, they're up here around this 28, 27-ish level, which has been fairly high. It's not the highest it possibly could go, right? But it's the highest in where, you know, maybe the most recent highs have been. Okay, so that's letting us know, yeah, we're definitely into higher volatility. Now, if we come back to Disney, you know, this guy trades awesome, right? 16 million shares traded today. What we're going to look for on this one is to go with this one. We're going to target the April 11s because I think there's some decent open interest in the strikes that we might target. If there's not, we'll just close it up and we'll come out 1 week more. Okay. What I had been anticipating doing here was the 104, 105. So 104, 105. There's a little bit of interest here, right? This is a little bit less than 100. This is like in the 60 range. So we really couldn't do many contracts if we do those. So let's just go to the 17s. The reason I stepped out of the 17s, actually, we're going to go back. The reason I didn't want to do the 17s is because we have $5 increments rather than the $1 increments. And the $1 increments allow you to get a little bit closer to the delta you might want. And so here we'd have a 46 delta or a 26 delta. And so sometimes we like to target, traders like to target a 30-something delta, which wasn't giving an opportunity for it here. So that's actually why I went back up to the 11s. Let me make sure it was really the 11s. That's what I wrote down. I'm just going to peek and see if the April 4s are more liquid. A little bit. Okay, let's go with the April 4s here. And a little bit more open interest and some activity here today that will bump the open interest for tomorrow. And at a 34 delta, let's go 102. And let's spread it out to the 105s where, again, we see some decent open interest. All right, that's how we're going to attack this one. So our 102 with that 34 delta, we'll just say sell vertical. And then we're going to spread it out. We're going to make this one be 105. Okay, and just so we can be in the better open interest. 78 cents credit on a $3 wide spread is what we're looking for here. So what, $2 and what, 80 or 12 cents to lose or to risk. And what do we have to gain here? About 78 cents per contract. Okay, let's do our quick position sizing here. And we're only going to do one trade on this one. We're not going to do multiple strikes like we did on the first one. So if we have, say, 3 minus, we'll make sure I have my math exactly right here, 222. Okay, good thing we did the calculator. 222 is what we have at risk. So 78 cents divided by 222 is about a 35% return. And sometimes people like to calculate that to determine, hey, is this a good enough return for what I would like? And this is we're looking to get that in 24 days. We're going to do the same thing here where we say, if we get a chunk of it, we're going to go buy it back. So our loss there was 222. If we can risk in our trade $1,500, 222 would be our loss per contract. We can do 6 contracts on this one. Okay, so up our contracts to 6. First triggers sequential or creates, we'll do an opposite order there. And then let's do the same thing. Let's go for 60%. Okay, maybe we can hit 60% by the end of the week. That would be pleasurable, right? We would like that. So 78 times, we're going to go, okay, if we've captured 60%, only 40% is left. Let's go buy this back at 31 cents. And we're going to make that good till canceled. This as well, we are going to put in our option strategies bucket. Now, do want to reiterate, it is at the lower end of that time of window that traders feel comfortable selling a lot of times, out 20 to 40 days, 20 to 50 days. So it's at the lower end of that. And that's fine. Okay, it is within that range. And let's put this in our option strategies bucket here. All right. Now, need to follow up on something here. Have all of you guys become a subscriber to the Trader Talks YouTube channel? I sure hope so. It makes your finding our content so much easier when you're a subscriber. And so here I'm on the Trader Talks channel here. And yours, if you haven't subscribed yet, has a subscribe there. You can also hit down in the bottom right corner of your screen, that little blue YouTube logo that says subscribe on it. You can click on that. Then it just makes it easy for you to find our content here. When I had this open initially, Mike was just finishing his class with swing trading, and then it would show this class going up right now. And then we show you some things that have happened very recently. It's easy to go find the playlist if you're like, I'm going to kind of go back and see some of the classes we've done before here in this class. With swing down here, several rows. It's kind of at the bottom here. Let's see. Maybe I skipped on it. Our class here. No, that's one more of our beginner class. I should have counted which row it was on before we started here. In any case, if there's a playlist you're trying to catch up on, trying to binge watch, pull up the playlist here, then go down and find it. And you'll see the list of all those classes that you have to be able to go back to. Okay? So do yourself a favor, do that. Makes your life easier. I love that feature on YouTube. Okay, I subscribe to several things and it just helps me find exactly what I'm looking for. And just, some of you listening on your phone, you can just tap it, get out exactly to where you want to be. All right. Well, today we focused more on, hey, what's going on with implied volatility? What's going on with the ATR, that we're having larger trading ranges. We're seeing some whipsaws throughout the day, right? From the low to the highs getting bigger and bigger. And so that really can influence your trades and your mindset as far as what you're looking for, okay? Put a cross through most of the bullish strategies, and because we're seeing such big moves, maybe neutral strategies might not quite be the ticket either. We focused here on the short call vertical in a kind of a normal time frame, and then we did one that's accelerated. We're going to see that other one that only has about 2 weeks before it expires. In fact, a little less than 2 weeks. All right. My encouragement to you is to try doing some of these in your paper money account. Get comfortable with some of these big movements we're seeing. Feel comfortable with where you want to get out. We put some profit targets on. I'm going to go back to the first trade that we didn't put profit targets on. I'll put them on that one as well, so that we know, hey, if we get a big chunk of this, we want to be out. All right, now this is the last class for the day. So do appreciate you being here. Again, we've got the survey out there if you wouldn't mind filling that out. As coaches, we really appreciate the time you take to fill that out. We read through everything. Our managers read through everything. We want to know, we want this class to be as good for you as we can possibly make it, okay? So we love to see what your ideas are. And I said as well, if you have other things you want to communicate with me, feel free to do that in the survey. Cameron, thank you for your help today. This is the last class, but we'll be back again bright and early right at the opening bell tomorrow morning with Trader Talks. I believe that Kevin Horner will be there leading that discussion. So we will see you bright and early in the morning. Thanks, everyone. Have a good afternoon. Bye-bye.